This is a demonstration of problem 17-7B, available for sale and held to maturity debt securities entries. The following information relates to the debt securities investments of Houston Company. On March 1st, the company purchased 6% bonds of Susie Company having a par value of $250,000 at 100 plus accrued interest. Interest is payable July 1st and January 1st. So we're first going to record the entry for the purchase of the Susie Company bonds. Since these bonds were purchased between interest payment dates, we need to calculate the amount of interest. The bond's stated value is $250,000. The interest rate is 6%. It has been 2 months since these bonds paid interest because we're purchasing them on March 1st and the last interest payment date was January 1st. So that means there is $2,500 of accrued interest that we will have to pay to the previous owner. So to record this entry, we would debit our debt investments for the par value, $250,000. We would debit interest revenue for $2,500, and we would credit cash for $252,500. On June 1st, 8% bonds of Sarah Inc. were purchased. These bonds, with a par value of $500,000, were purchased at 100 plus accrued interest. Interest dates are September 1st and March 1st. So again, we will need to calculate the amount of accrued interest that will need to be paid when we purchase the bonds. The face value of the bonds is $500,000. The stated interest rate is 8%. It has been 3 months since the last interest payment date because we're purchasing the bonds on June 1st and the last interest payment date was March 1st. So we can calculate the amount of accrued interest at $500,000 times 8% times 3 divided by 12, or $10,000. So we would debit the debt investments available for sale for $500,000. We would debit interest revenue for $10,000, and we would credit cash for $510,000. On July 1st, we received the first semi-annual interest payment on the Susie Company bonds. So we will receive now the entire 6 months of interest. So $250,000 times 6% times 1 divided by 2 is $7,500. So we would debit cash for $7,500 and we would credit interest revenue for $7,500. And if you notice, that will net out to be the amount of interest that we actually earned for the 4 months that we own these bonds. On September 1st, the semi-annual interest is received on the Sarah Company bonds. To calculate that amount, $500,000 face amount times 8% times 1 divided by 2 is $20,000. So to record the receipt of the Sarah Company interest, we would debit $20,000 to cash, and we would credit interest revenue for $20,000. And again, that would net out to be the 3 months of interest that we should receive since we purchased the bonds on June 1st. On October 1st, bonds with a par value of $100,000 purchased on June 1st are sold at 101 plus accrued interest. So we are selling $100,000 of the Sarah Company bonds, and they are sold at a premium. We know that because it says they are sold at 101, and we will also receive the accrued interest for the additional month since the last time that the bonds paid interest on September 1st. We are not selling the entire bond issue, we're only selling $100,000. So we will have to calculate the accrued interest for 1 month on $100,000 at 8%, and that's $667 in interest. We will also be receiving $101,000 since the bonds are being sold at 101. So we will have a gain on the sale of the bonds for $1,000. The $101,000 that we received minus the par value that we paid for the bonds. So to record this entry, we would debit cash for $101,667. We would credit our debt investment account for the par value, $100,000. We would credit interest revenue for the $667 for the 1 month of interest, and we would credit gain on sale of bonds for $1,000. At December 31st, it states that the fair value of the remaining bonds that were purchased on March 1st and June 1st are $98 and $103 respectively. So the instructions ask us to prepare the adjusting entries. The first thing that we need to do is to accrue the interest on the bonds for the period of time since we last received interest. So the Susie Company bonds paid interest on July 1st. They will pay interest again on January 1st. So we will accrue an entire 6 months of interest on the Susie Company bonds, $250,000 times 6% times 1 divided by 2. For the remaining Sarah Company bonds, we have $400,000 of those left. We will multiply that face amount times the stated rate of 8% and then multiply that by 4 divided by 12. We determined that because the last time that we received interest on the Sarah bonds was September the 1st, so that's been 4 months. So that amount would be $400,000 times 8% times 4 divided by 12, or $10,667. So the total for both bonds, $7,500 for the Susie Company, $10,667 for the Sarah Company, would be $18,167. So we would debit interest receivable for $18,167 and credit interest revenue for the same amount. These are available for sale securities, so we also will need to make an adjusting entry for the fair value of the bonds. The problem told us the fair value was $98 for the Susie Company bonds and $103 for the Sarah Company bonds. We know the original par value of the Susie bonds was $250,000, so the fair value is 98% of that, or $245,000. The Sarah Company bonds par value was $400,000, so the fair value at 103 is $412,000. The unrealized holding gain loss for the Susie Company bonds is $5,000. The unrealized holding gain for the Sarah Company bonds is $12,000. The overall portfolio had a $7,000 unrealized holding gain. So to make the fair value adjustment at December 31st, we would debit fair value adjustment available for sale for $7,000, and we would credit unrealized holding gain equity for $7,000. The B portion of the problem states, if Houston classified these as held to maturity investments, how would the journal entries differ from those in Part A? All of the journal entries would be exactly the same, except there would be no entry for December 31st to adjust the portfolio to fair value. And that is the conclusion of the demonstration for problem 17-7B.